September-December 2020 SBR paper question number 3. So requirement A, describe the main challenges in recognizing and measuring intangible assets such as brands in the statement of financial positions for 5 marks. Right? So there is an IFRS for this intangible assets. Using that you have to answer how you have to recognize and measure. Part B, as you can see there are many parts under part B, 4, and it is recommended based on my experience and what I have seen is that it is better to answer this in order. First one first, second, third, and fourth, right? So discuss the following accounting entries relating to Cobal's financial statements for the year ended 31st December 2016 in accordance with IFRS standards. Here they didn't clarify which IFRS standards, so you have to think which IFRS standard, right? Whether the Genji brand name will be accounted for separately from goodwill on acquisition and whether it should be accounted for as a separate cash generating unit after the integration of manufacturing units. So here the word is brand name. What is brand name? It's an intangible assets. So here they are saying whether this intangible assets, they have to be accounted separately from goodwill on acquisition. We know when we acquire a company, there's a goodwill on acquisition. So whether it has to be acquired separately, and so there is a two requirements under one. And this word answer, there's another requirement. Whether it should be accounted for as a separate cash generating unit after the integration of manufacturing units for 4 marks. Then coming to 6 marks. How to account for the intangible assets with indefinite life. So intangible assets with indefinite life. So this is mainly talking about intangible assets, as you can see. I'm sorry. Okay, and whether the Locust and Clara Perform brand names may be regarded as having an indefinite life. So you have to tell whether this and this, they are perfume brand names, right? They have indefinite or definite life. Third, how to account for the proposed closure of the 6 stores and suggested closure of the remaining stores. 6 marks. Last, whether the primary store should be tested for impairment, right, at 31st December 2007. Whether it's intangible assets, whether it's tangible assets, this impairment will come. That's another area where you have to be very, very thorough because impairment will anyhow in any one of the question. Sometimes it might be repeated also in several questions. In SBR, it will come. So you have to be prepared for impairment. And whether the internal sales can be attributed to this store, right? Just give me a few minutes. Okay. So now let us go to the case study and read. This is for 25 marks. So Cobalt trades in the perfume sector. So definitely we know that perfume is an area where it's a brand is there, right? So brand means intangible assets. So this question mostly will deal with intangible assets. It has recently acquired a company for its brand Genji or Genji, you can pronounce it in any way, right? Purchased 2 additional brand names. It also purchased a company and also 2 additional brand names and has announced plans to close its Italian stores. So it's buying and closing. Cobalt also opened a new store on a primary site in Paris. Okay, so you can see this is a mixture of open and closing. He's closing some, he's opening somewhere. So do not get confused. We'll deal with this one by one. The current financial year end is 31st December 2007. Acquisition of Genji company. Okay, so on 1st of Jan 2007, Cobalt acquired 100% of Genji company. Both company, that means it's a subsidiary company. Okay, so Both companies operate in the perfume sector. Cobalt intends to merge the manufacture of Genji products in its own facilities and close Genji's manufacturing unit. Okay, so Genji's manufacturing unit they will close. With the Cobalt, they will adopt the Cobalt's manufacturing unit. Was they acquire Genji company? So Genji's brand name is well known in the sector, retailing at premium prices, and therefore Cobalt will continue to sell products under the Genji brand name after its registration has been transferred and its manufacturing units has been integrated. So the directors of Cobalt believe that most of the value of Genji was derived from the brand, and there is no indication of the impairment of the brand. There is no indication of the impairment of brand. Impairment is also important. We have a requirement for impairment also, and most of its value is from the brand. That is intangible asset. Acquisition of perfume brand. So in addition to now owning the Genji brand, Cobalt has acquired two other perfume brand names to prevent rival acquiring them. We know that when you have acquired most of the company with good brand names than this one, it will be more harder for your rivals to acquire you, because now you are an integration of several brands, not just one. So the first perfume Locust has been sold successfully for many years and has established market. The second is a new perfume which has been named after a famous actor Clara who intends to promote the product. The directors of Cobalt believe the two perfume brand names have an indefinite life. Plan to close and sell stores. Okay, so Cobalt approved and announced a plan to close and sell all 6 Italian stores on 31st December 2007. The 6 stores will close after a liquidation sale, which will last for 3 months. Management has committed to a formal plan for the closure of 6 stores and has also started an active search for a single buyer for their assets. Has committed a formal plan and also active search for a buyer. The stores are being closed because of the increased demand generated by Cobalt's internet sales. A local newspaper has written an article suggesting that up to 30 stores may be closed with a loss of 500 jobs across the world over the next 5 years. The directors of Cobalt has denied that this is the case. Cobalt's primary store. Cobalt Company's primary store is located in central Paris. It has also recently been opened at a significant cost with the result that management believes it will make a loss in the current financial year. It will make a loss in the current financial year. Future operating loss, right? So the list loss making is not of concern as the performance is consistent with expectations from such a new and expensive stores, and management believes the new store will have a positive effect on Cobalt's brand image. If impairment testing of the primary store were to be required, then Cobalt would include the cash flows from all internet sales in this assessment. The goods sourced by the internet are sourced from either Cobalt's central distribution or individual stores. Internet sales are either delivered to the customer's home or collected by the customer from the store supplying the goods. Okay, so first what we have to do, again reread your requirements. It's a good habit if you adopt this. After you read the case study, again read it so that you didn't forget what you are supposed to answer. First, recognize and measure intangible assets such as brands in the statement of financial position, 5 marks. Let's see how the answer has been given. So there are many challenges in recognizing and measuring intangible assets such as brands in the statement of financial position. We all know that. It's not easy to measure intangible assets, mind you. But tangible assets, yes. Why? Because intangible assets, it does not have a market like how tangible assets has. So we'll see what are those and how you have to measure and recognize. So many intangible assets are not frequently traded. What are the challenges? Again, wait, let me read it because I think I misunderstood it. Okay, so this is not about measuring and recognizing. This is describe the main challenges. Now you see what mistake I did. So this mistake you also can do. We thought that we have to recognize and measure. How we have to recognize? No, the question asked, describe the main challenges in recognizing and measuring intangible assets, the problems, the cons. So this is what happens when you misinterpret a question. So what are those challenges? Many intangible assets are not frequently traded on a standalone basis. We all know. Brand, it's only your brand, right? You have a brand. It will not be similar. Other brands will be different. So it's not a frequently traded market. That's number one as a challenge. Not frequently traded on a standalone basis, and therefore very often there is no active market for them, which makes arriving at a valuation more difficult. Valuation becomes very difficult because there's no active market for it. So additionally, many intangible assets are unique. Intangible assets are unique, and therefore it is not easy to identify and assess their value. Valuation methods are often complex and subjective. It is complex also, valuation is complex also, it is subjective also. And the measurement is more subjective when the intangible assets are not based on legal enforceable rights. In some cases, acquirer does not intend to use intangible assets. For example, Cobalt has acquired brands for defensive reasons. Why they have acquired brands? So that their rivals cannot take over them. They want to defend themselves from an accusation. That's why they have acquired. It is not for what? To use those brand, those intangible assets, right? And this raises issues with regards to arriving at a value. Finally, determining the useful life of intangible assets can be subjective. Useful life is definitely subjective, right? 3 years, 4 years, some useful life you give, right? How do you know that the brand will have this many years? It might, what happens if tomorrow, after 5 years, let's say your brand is diminishing in value, right? You cannot say it's a subjective. Because it is subjective, it is more difficult. Generally, the reason for the omission from the financial statements of intangible assets. Now you're linking this with financial statements. Usually we don't include all the intangible assets. There are only some. Why we omit from financial statement is because of intangible assets has been due to a perceived lack of a link between their cost and estimating future revenue. Exactly. Because there is a lack of a cost and estimating future revenue for intangible assets. In addition, the difficulties in asserting cost of valuation figures for intangibles and a focus on reliability over relevance when disclosing asset information have meant that internally generated intangibles has not usually been recognized. Internally generated intangibles we don't usually recognize because there's no active market. It is internally generated in your company. Hard to put a value for that. However, the importance of intangible is reflected in the increasing proportion of a company's market value being attributable to the existence of intangibles. Intangible assets are not physical assets that can be easily recognized. Exactly. It cannot be easily recognized because it's not physical. In some cases, perceptions may clash and what may seem like an intangible to one party may appear not so to another. Alright? So coming to part B of it. Brand name, whether it will be separated from goodwill and acquisition and whether it should be accounted as a separate cash generating unit. 4 marks, right? So here first we'll see. The JG brand will generate future economic benefits by increasing sales volume and potential of premium prices. Control over this potential future benefits is achieved by the registration of the brand. The registration also satisfies the requirement to identify the identifiable asset separately from goodwill. So you have to identify separately from goodwill and estimate of its fair value. Right? Before that, all the 3 lines you have to tell that it will generate future economic benefits, sales volume will increase, therefore premium prices, right? Now, for impairment, it is cash generating unit. When you're talking about cash generating unit, you have to refer to one IAS, which is IAS 36, impairment of assets. Without this, you cannot talk about cash generating unit because this IAS already deals with cash generating unit. So first you have to say what cash generating unit is. You have to define. Definition is important for such terms, cash generating unit. Right? It is the smallest identifiable group of assets that generates cash inflows that are largely independent of cash inflows from other assets or other groups of assets. So, straightly taken from your textbook, I'm not explaining it. However, brands, you have to tell whether brands are cash generating unit. Can they generate cash on their own or not? So brands are okay. Let me highlight it. It's better. Brands are typically not separate cash generating unit under IFRS. Are they? No. So the brand would be tested for impairment together with associating manufacturing facilities. They will be tested for impairment. Together with associated manufacturing facilities, the brand would be separately identified and valued. So the brand will be separately identified and valued and should be allocated to each of the Cobal's cash generating unit that are expected to benefit from the synergies of the combination. IS 36 recognizes that sometimes there is no basis for allocating the brand to an individual CGU and that is not arbitrary. So it permits it to be allocated to a group of CGUs. Individual CGU is not easy. There's no basis how you're going to allocate to individual CGUs. So, but it permits to allocate to a group of CGUs. However, each CGU must represent the lowest level within the activity within the entity that is monitored for internal management purposes and not be larger than an operating segment. You have to have a very good understanding of CTO to answer this. This is not an easy question. Second, 6 marks. How to account for intangible assets with indefinite life, because they told they have indefinite life, both Locus and Clara perfume. So here you have to talk about IS 38, which deals with intangible assets. Intangible assets have an indefinite useful life and there is no possible limit to the period over which, based on an analysis of all relevant factors, the asset is expected to generate net cash inflows for the entity, and which is at IS 38. An intangible asset with an indefinite useful life should not be amortized. The one which has indefinite useful life. Intangible asset with indefinite useful life. It's a rule. IS 36. You also need IS 36 because they're talking about impairment. So when I talk about intangible assets, IS 38. Impairment of intangible assets, IS 36. 2 IS is dealing here. IS 36 also. Requires an entity to test. How do you test for impairment? You will test each year whether there is an impairment or not of factors. So test an intangible asset with an indefinite useful life for impairment by comparing its, you have to talk about this, recoverable amount with its carrying amount. This two you have to talk A and B annually, and whenever there's an indication that intangible asset may be impaired. Now, the useful life of an intangible asset that is not being amortized should be reviewed each period to determine whether events or circumstances continue to support an indefinite useful life assessment for that asset. Right? Even if it's not amortized, it has to be reviewed whether still it has an indefinite useful life or not. If they do not, the change in the useful life, see, sometimes it changes from indefinite to definite, from definite to indefinite. So that change, if they do not, the change in the useful life assessment for indefinite to finite should be accounted for as a change in accounting estimate. If it changes from indefinite to finite, it is known as change in accounting estimate. Where will it be dealt with? IS 8. So you can see 3 IS are dealing with one. This is a hidden IAS. You have to identify all this hidden IAS sometimes, which is hidden in the main. Main is what? IS 38, intangible asset. But with that, we have IS 36 because impairment. With that, we have IS 8 also because it might change from indefinite to finite. That change is known as change in accounting estimate. You have to be very clear whether it's change in accounting estimate, change in accounting policy, or is it an error. This is not an error. This is not a policy. It's an estimate. We estimated it was indefinite, but now it is finite. So now, COBOL should consider various factors to determine whether the brand can be considered to have a useful. They will include the extent to which COBOL is prepared to support the brand and extent to which the brand has long-term potential and has had proven success. Perfume is often subject to market and fashion trends, and therefore an assessment of how resistant the brands are to change should be made. Also, COBOL has purchased the brand as a defensive measure to prevent rival acquiring. Therefore, there may be a doubt as to support that COBOL may prepare to give to the brand. Support, okay. Now, the locust. We are talking about the two perfumes, the Clara and Locust. The Locust perfume has been sold successfully in the market for many years. From the case study, it is clear they have told. And could be deemed to have an indefinite life. It could deem to have an indefinite life. The Locust. Clara perfume is linked to the popularity of the actor, and therefore it is difficult to assess whether the brand has an indefinite life. It is difficult here. Wherever it is difficult to assess, you have to clearly write it's difficult to assess. Because it is linked to the actor of the popularity of the actor. Popularity keeps changing. Popularity anytime can go. But when a perfume has been successfully sold in the market for many years, yes, that is indefinite life. Because you exactly cannot predict how many years, so indefinite. As it is dependent upon the longevity of the popularity of the actor. In the case of the Clara, it is difficult to state that the brand will have an indefinite life. Thus, Clara is likely to have a finite life. Isn't it so? Because how can an actor's popularity will be an indefinite life, right? There's a limit to that. It could be 5 years, 10 years, 15 years. Third, how to account for the proposed closure of 6 stores and the suggested closure of the remaining store. It is known as what? Main is IFRS 5. IFRS 5 is a small IFRS. which this IFRS is also a one which comes frequently, so you have to be prepared for IFRS 5 as well. IFRS 5 non-current assets held for sale and discontinued operations. Exactly. When you have to close some sell or close means sell off, it is dealt in IFRS 5. States that, okay, what does this say? It states that immediately before classifying a disposal group as for a group as held for sale, carrying amount of assets and liabilities within the group are measured in accordance with applicable IFRS standards. After classification as held for sale, disposal groups are measured at the lower of carrying amount and fair value less cost to sell. All these are from the standard. In the IFRS 5 you will see impairment must be considered both at the impairment has to be there even for this group. Impairment must be considered both at the time of classification as held for sale and subsequently after classification. Both the periods impairment has to be considered. So the 6 stores should be accounted for as the discontinued operation as they represent a component of COBOL and a separate geographical area of operations. Approval and announcement of a plan to close the 6 Italian stores is an indication that the assets attributable to the discontinuing operation may be impaired. Right? Approval and announcement that they will be closed. It leads to what? That they may be impaired. So in addition, the 6 stores would be classified as a disposal group, which is a group of assets that an entity intends to dispose of in a single transaction. The measurement basis required for non-current assets classified as held for sale is applied to the group as a whole, and a resulting impairment loss reduces the carrying amount of the non-current asset in the disposal group in the order of allocation required by IAS 36. What is IAS 36? Intangible assets, dealing with what? For impairment. Impairment, right? Additionally, there may be a need to provide for the additional cost of closure such as redundancy cost. Exactly. What is redundancy cost is dealt in IAS 37. Right? It's not over yet. At the end of each reporting period, an entity is required to assess whether there is an indication that an asset may be impaired. Yes. Its carrying amount may be higher than its recoverable amount. IAS 36 has a list of external and internal indicators. See IAS 36. When you're talking about impairment, list of external and internal indicators of impairment. If there's an indication that an asset may be impaired, then asset recoverable amount must be calculated. When there's an indication of impairment, entity estimates the recoverable amount of the assets and records an impairment if the recoverable amount is lower than the carrying amount. Although there has been a local newspaper article that COBOL is to shut 30 stores with a loss of 500 jobs. See, this is not the case study exactly. Across the world over the next 5 years, there has been no formal announcement by COBOL, and therefore, until there has been formal plans drawn up to close the additional stores, there should be no provisions. You have to be very clear. Sometimes we always have a habit of, okay, recognize as provisions, recognize as this, recognize as that. Sometimes there's no need to recognize it based on the facts of the case study, because even if it's in the newspaper, company didn't make any formal announcement. Therefore, there cannot be any provisions. There cannot be any provisions for that. So provisions, no provisions made for the store's potential closure and in loss of jobs. Even if there's a potential closure and loss of jobs, still provisions cannot be made until the company makes some formal announcement. It is feasible that the closure of the additional 24 stores will not take place. And there is no constructive obligation unless there is at least a detailed formal plan. Even there is no detailed formal plan also. So there's no constructive obligation also. So the directors have denied the fact that the additional stores will be closed. Even the directors have denied it. So the last requirement is whether the primary store should be tested for impairment and whether internal sales can be attributed to this store. This term is primary store. So here, as stated in A, second, an entity needs to assess at the end of each reporting period whether there is an indication that asset may be impaired. They talked about impairment. An indication of impairment is whether the performance of the asset is worse than expected as the primary store is performing in line with expectations. It would appear that at present there is no indication of impairment and there is no impairment test is required. Additionally, if COBOL feels that private store benefits all other stores from brand perspective, it may be appropriate to treat the store as a corporate asset and allocate its cost to the other stores for impairment testing. The amount of internal sales included in any impairment assessment of the primary will depend on the quantity of sales that are sourced directly from it. Where internal sales are sourced from a central warehouse or another store, cash inflow should be excluded from the primary store's impairment assessment and included in the appropriate CGU. Right? That's it. And so the last question we have is question 4, and then we are over with September-December 2020 SBR paper. Thank you, and don't forget to subscribe to this channel. Take care.